Hey everyone, this is Corey with Sims Investment Management, and this is another market update. And September ended up being a down month. We took a little bit of a breather from the rally that we've had since the March 23rd bottom. And there's a couple concepts that I kind of want to go over today. We did pull back almost 10% in September. We finished the month down almost 4%. And that was healthy. We need to kind of digest some of this news via time, and historically speaking, September and October, although still positive, they are the least amount positive months when you look over history. And then we tend to take off in mid-November and get the Santa Claus rally and rally pretty hard into the end of the year and the beginning of the year when people are getting their bonuses and maybe putting some money, more money into the market. I want to talk a little bit about volatility today because I see all kinds of reports. I read an article that talked about how we hadn't had any volatility since April, which is just not factual in any way, shape, or form, because volatility is not just downward market movements, it's also upward market movements. Volatility, by its definition, is the deviation that we have from the long-term average. And so that's above the trend line and below the trend line. Unfortunately, the financial media historically just talks about negative volatility, and when things are going up, they don't talk about positive volatility. Positive volatility happens all around us all the time. If you look at the past 100 years, basically, of the market, we've averaged about a 10% rate of return. If we look back, there's a wonderful piece that's included in one of the attachments here that talks about the fact that the past 94 years, the market has only had 6 years where we've been between 8 and 12% returns. So even though we average 10%, we typically are nowhere near that number. We're usually above and below that long-term trend line, which is the definition of volatility. So don't let the financial media get you spooked out and think that volatility is always a negative thing. Without volatility, we wouldn't be able to get the type of returns that we get in the market. And when people think about the bond market or the real estate market, those by definition are less volatile because they're not valued as often. Bonds oftentimes are only valued once a month, so you have not as many price points to be able to see how volatile that bond would be. Real estate, as we know, is very illiquid. So if you don't have many sales on your house that some of you have been in for 10, 20, 30, or 40 years, then it's hard to really say that that is a volatile asset because you don't have any transactions going on. So that's a little bit on volatility, which leads me into the next point about the election. I continue to get a lot of questions about what's going to happen if this person or that person wins. And realistically, if we look back over history, I've been saying this for the past couple months, it has not really mattered who has been in office. The market has done well under Republican and Democratic presidents. We've done well under Republican and Democratic House and Senates because the market is driven by companies and earnings. And we have 500 of the greatest companies in the world in the U.S. And so Warren Buffett, who I quote on here all the time, he has a wonderful quote: mixing politics with investing is typically a really bad idea. And this is coming from a man that's arguably the greatest investor of all time, who has also said that if you look at his voting history, the president that he voted against has been in the office for more than 50% of the time. And he has done quite well for himself. So if it's been good enough for the greatest investor of all time, it should certainly be good enough for us. And when we think about the market, I keep getting this question a lot. Just because a stock price is down doesn't necessarily make that a good investment, right? We need to look at fundamentals. We need to look at company peers. And we need to understand what that business actually does. The last point that I want to make is when we're thinking about these companies and the impact that the election could have on them, believe it or not, the U.S. makes up 25% of the world's GDP. All right? So in any given year, we're basically 25% of the world economy. and yet we have less than 5% of the world's population. If you broke out our states, Ohio would be the 21st largest country in the world by GDP if you broke out the 50 states into their own countries. California would be the 5th largest country in the world by GDP. Texas is in the top 10, New York's in the top 15. So we have a lot of firepower, and we've had a long history of companies learning new market environments, new political environments to survive and thrive, because we, as citizens of the United States, mostly get up in the morning and go to work and try and produce and try and move our society forward. And until that changes, the United States is not going to crumble, no matter who is in office. So please take some solace in understanding, review the material that I've sent out, that we will be okay no matter who wins the election next month. And please do not change your long-term retirement goals just because you have one strong conviction or the other about a certain individual. That's it for this month. If you have any questions, I'm happy to talk about this further. Please check out some of the other resources and the introductory letter that I had this month, and we'll talk to you soon. Thanks.